Welcome to Breaking News to Trading Moves.
We are really glad you tuned into our discussion today.
Yeah, it is great to have you with us. We have a very specific item crossing the wire to look at.
Right.
The exact headline of the day is Norwegian Cruise Line warns on 2026 profit as fuel cost uncertainty rises.
And the plan for our discussion today is straightforward. First, we will provide a breakdown of the headline numbers.
And the why behind them, of course.
Exactly. Then following that, we will move directly into a clear list of the market winners and losers.
Starting with the numbers, Norwegian Cruise Line trading under the ticker NCLH guided its 2026 adjusted profit to about 2.38 per share.
Right, which is a visible miss.
Yeah, it came in below analyst expectations, which are sitting around 2.55 per share.
And when core business guidance misses the street by that margin, traders pay very close attention.
The gap between the 2.38 guidance and the 2.55 expectation is really the entire focus for traders right now.
It is, and the company gave very specific reasoning for this lowered outlook.
What did management say exactly?
They stated the long-term impact of geopolitical tensions on fuel costs remains uncertain.
Which is always a tough variable to model.
Right. Furthermore, they flagged a pressured environment characterized by weaker bookings and what they explicitly called execution issues.
Execution issues.
Yeah, I put that right out there.
Which explains the immediate market reaction we saw. Both NCLH and its peers sold off sharply.
Very sharply.
It reflects worries specific to the cruise industry's operating model colliding with a broader risk-off tone in the market.
Yeah, and the mechanics of cruise profitability leave very little room for error when input costs start running hot.
Let's talk about those mechanics. Why do traders care so much about this margin squeeze?
Well, fuel is a major variable cost for operators.
Right.
The ships have fixed itineraries. A large vessel sailing a 7-day Caribbean or Mediterranean route burns a high amount of bunker fuel.
Just to manage propulsion and hotel operations.
Exactly. Onboard amenities, too. Management cannot just decide to sail halfway or turn off the air conditioning to save money.
No, you cannot compromise the passenger experience like that.
Right, so even if the passenger count and the itineraries remain completely static, escalating bunker fuel costs compress profit margins rapidly.
We also have to look at the revenue side of this equation.
The demand side.
Yeah, the company cited a pressured environment with weaker bookings, specifically noting softness in higher price demand combined with flat net yield expectations.
And if you're watching the consumer discretionary space, that flat net yield commentary is a real red flag.
It tells the market that pricing power is capped exactly when costs are climbing.
The elasticity of demand in the cruise sector is showing limits.
Consumers are feeling macro pressure.
They are. So while they might still take the vacation, they trade down.
Bypassing the premium suites.
Right. They bypass the balcony cabins and book interior rooms instead. They cut back on high-margin onboard spend like specialty dining or casino play.
And the cruise lines cannot simply pass the rising fuel costs onto the consumer via higher base ticket prices.
Because the consumer is already signaling price sensitivity.
I want to focus on the company's mention of execution missteps for a second.
That is a tough phrase.
It is a phrase that instantly puts analysts on the defensive. It implies unforced errors.
It introduces a layer of management risk on top of the macro risk.
Are we looking at a long-term reset for NCLH, or are these the kind of operational hurdles that can be smoothed out in a quarter or two?
The market penalizes the phrase heavily. An execution issue could mean a failure in their yield management software or poorly optimized marketing spend.
Or misallocating ships to regions where port fees are climbing, but passenger demand is softening.
Exactly. If competitors are navigating the same geopolitical environment and the same bunker fuel pricing without issuing the same dire warnings.
And the problem is isolated to NCLH.
Right.
If you look at their peer group, they are all buying the same marine fuel.
They are.
So if one operator is missing the mark, analysts immediately question the internal hedging strategy.
Did NCLH fail to lock in favorable forward contracts for their fuel needs compared to the rest of the industry?
That is the exact question institutional investors are asking on the earnings calls.
If a company gets caught underhedged in a volatile energy market, that is an execution failure.
And it takes time to course-correct a fleet deployment strategy or rebuild a derivatives book to protect against fuel spikes.
It certainly does.
Summarizing the setup here, this is a classic guidance plus costs warning. Earnings are guided down, costs are flagged as the headwind, and internal execution is questionable.
If oil stays volatile, Cruise names act like leveraged travel beta,
They fall fast on margin fear.
and they will likely only find a floor when both the fuel curve and booking commentary stabilize,
We can see capital rotating out of this vulnerability and into specific beneficiaries.
which takes us to the market winners.
Yes. The first group of winners pulling capital today are the integrated oil majors. The primary tickers to watch here are XOM and CVX,
Geopolitical risk keeps the floor under oil prices.
which drives stronger upstream revenue for these integrated majors.
What we are seeing in the tape today is a textbook rotation. Investors frequently move capital into energy as a direct hedge against travel and consumer weakness.
Wait, I have to push back on that as a foolproof hedge.
Okay, go ahead.
If portfolio managers are rotating into XOM and CVX to offset their travel beta, isn't that just a short-term trade?
How so?
If the consumer actually pulls back and travel volumes plummet globally, marine and jet fuel demand eventually drops, doesn't that drag crude right back down, pulling the integrated majors with it?
That is the structural bear case for energy. But the timeline is the key variable for traders.
The timeline.
Yes, the market is pricing in the immediate geopolitical supply risk today. The demand destruction you were talking about takes several quarters to manifest in the inventory data.
A true drop in global travel volume takes time to show up.
Exactly. For the next 3 to 6 months, the rotation into XOM and CVX provides a highly effective buffer for portfolios heavy in discretionary consumer names.
Moving beyond the integrated names, the next group of winners are the U.S. shale and independent producers.
The specific tickers being OXY and EOG.
The dynamic here is slightly different from the majors.
Higher crude elevates the cash flow expectations for pure-play producers
This immediately improves their free cash flow profiles.
and expands their buyback capacity. Unlike the integrated majors that have refining and chemical segments to balance out crude volatility, independent producers are levered directly to the extraction price.
Because OXY and EOG are pure play operators, this crude environment supercharges their cash generation.
And modern shale operators are aggressively deploying that excess cash into share repurchases.
Which establishes a much firmer floor for their stock price compared to the vulnerability we are seeing across the travel sector.
The capital discipline in the shale patch changes the trade entirely.
Management teams at OXY and EOG are not using the extra cash to recklessly drill new wells the way they might have a decade ago.
They're returning it to shareholders. That visible buyback support attracts institutional capital looking for safety when the broader consumer discretionary trade starts flashing warning signs.
The final group of winners to monitor are the refiners.
The tickers here are MPC and VLO.
In periods of energy volatility, refining margins can widen rapidly.
If product spreads remain favorable, refiners routinely outperform even when specific segments of consumer travel weaken.
The stickiness of those product spreads is crucial here, the crack spreads.
Right. Even if cruise lines are struggling with profitability, they still have to buy the marine fuel.
And the refiners dictate the price of that refined product.
Refiners benefit from the complexity of the global supply chain. Geopolitical tension often disrupts the flow of refined products more severely than raw crude.
So facilities operated by MPC and VLO can charge a premium for diesel, gasoline, and bunker fuel.
Their margins expand based on that regional scarcity, completely detached from whether a cruise line is filling its balcony suites or its interior rooms.
Now we have to flip the board and look at the other side of the trade, the losers.
Unsurprisingly, the first group includes cruise operators and companies with direct cruise exposure.
The tickers taking the hit are NCLH, CCL, and RCL.
A guidance disappointment paired with fuel cost uncertainty is the exact formula that pressures near-term earnings confidence.
When analysts cannot accurately model fuel costs due to geopolitics and simultaneously see consumer demand softening valuation, multiples compress.
The entire peer group trades down together in sympathy.
That multiple compression is ruthless. In this scenario, analysts have a double blind spot.
They cannot forecast the bunker fuel input costs, and they cannot forecast the net yield revenue.
When you lose visibility on both the top and bottom lines, the market demands a severe discount for holding the equity.
Traders do not get the benefit of the doubt in a risk-off environment.
Even if CCL or RCL come out and say their forward bookings are holding up better than NCLH, the market will still sell them off today.
The sector trades as a monolith until the individual earnings prints prove otherwise.
That sentiment spillover brings us to the second group of losers, travel and leisure names with high fuel sensitivity.
The immediate tickers in the crosshairs are the airlines, specifically AAL and UAL.
When headlines focus heavily on fuel volatility, the market systematically marks down travel names with thinner operating margins or high sensitivity to jet fuel and discretionary demand.
Even if the underlying fundamentals between a cruise line and an airline differ, sentiment bleeds across all travel beta.
If marine fuel is squeezing NCLH, it immediately forces traders to look at the airline complex.
AAL and UAL operate on notoriously thin profit margins, where jet fuel is often their single largest variable expense.
Just like a ship cannot sail without bunker fuel, an airplane cannot fly without jet fuel.
And jet fuel pricing is highly correlated with the same crude oil benchmarks affecting the cruise industry.
Traders pull up their models for AAL and UAL and stress test them with the same rising energy costs currently penalizing NCLH.
The difference in pricing power is worth noting, though.
Airlines can sometimes adjust capacity faster than cruise lines.
They can trim underperforming routes.
But the market operates on a sell first, ask questions later mentality. If the consumer is avoiding premium cruise cabins, algorithmic trading assumes they will also avoid premium airline seats.
The assumption is that discretionary travel budgets are shrinking universally.
That brings immediate pressure to our final group of losers: online travel agencies, or OTAs.
The primary tickers are BKNG and EXPE.
If higher fuel costs and macro uncertainties start denting discretionary travel, demand, booking volumes, and take rates come under intense scrutiny.
The immediate market move is multiple de-risking for these platforms.
OTAs operate as a derivative of the broader travel industry's health.
They do not buy jet fuel, and they do not have the capital expenditure of building cruise ships.
However, their revenue is entirely dependent on total gross bookings and the volume of transactions.
Right. Their model relies on capturing a percentage of millions of transactions.
They are somewhat insulated from the direct fuel costs, but if macroeconomic uncertainty causes a spike in cancellation rates or if consumers just stay home, the total volume of bookings drops.
A volume drop directly hits their top line.
When a major operator like NCLH flashes a warning sign about weakening consumer demand, traders immediately lower their valuation multiples for BKNG and EXPE.
In anticipation of a sluggish quarter, the multiple de-risking happens before the OTAs even report their own numbers.
Looking ahead, there are specific metrics traders need to track to see how this narrative evolves over the coming months.
There are three primary items you should monitor. First is the direction of oil and marine fuel.
If crude continues to climb, the cruise margin story will remain under heavy pressure.
Tracking the daily spot prices and the forward curves for energy is essential.
The cost of a barrel of crude is the absolute anchor for this entire trade. As long as geopolitical premiums remain in the oil market, the travel sector will struggle to find a sustained rally.
The second item to watch is booking commentary. Traders need to parse future updates for details on pricing, onboard spend, and load factors across NCLH, CCL, and RCL.
Load factors will tell you exactly how full the ships are.
But the onboard spend is the real pulse check on the consumer.
If load factors stay high but onboard spend plummets, it confirms the thesis that consumers are aggressively hunting for bargains and closing their wallets once they get on the ship.
The third item is cost actions. You need to look for any fleet deployment changes, adjustments to hedging strategies, or aggressive overhead reductions.
These actions are the only levers management can pull to stabilize the narrative.
Tactical fleet deployment can make a difference. If fuel costs are disproportionately high in Europe, management might reposition ships to the Caribbean to protect margins.
Additionally, any clarity on their forward fuel hedges will go a long way in calming analyst fears regarding those execution missteps we discussed earlier.
It requires vigilance to track the interaction between the commodity markets and consumer behavior. Think about how much a company's success relies on factors completely outside their control, like global fuel prices or geopolitics, versus their own internal execution. When a company warns on profits, where exactly is the line between bad luck and bad management?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you for joining us.